Many of you have probably heard of 100 Women in Finance, which is a global network initiated in the US and focused on empowering gender diversity in finance. I'm delighted to let you know that 100 Women in Finance is coming to Africa. With the networks that we have through executives in Africa, I'm actually been appointed on the Global Advisory Council for 100 Women in Finance to help set up the networks and core hubs in Africa. So if anyone wants to know about that, wants to get involved, is committed to gender diversity, as I know is really important, and supporting raising awareness of the opportunities in finance for women from very much preschool through mid-career up to senior career women, then please do come and visit us at the Executives in Africa stand. I've got some information on 100 Women in Finance. Really, really important to spread the word and get this going. Without further ado, I'm hoping, I've not actually seen him, I'm hoping Andrew is in the room. Oh, fantastic, thank goodness. So I'm going to be introducing our next speaker, Andrew Brown from Delphos. He has nearly 20 years experience in project finance, corporate finance and private equity in frontier markets. He's worked on over 24 successful financing, totaling more than $5 billion in capital deployment and transacted in over 30 frontier markets, including nearly 20 African countries. He served as a president of Delphos International since 2021, where he has oversight of the growth and operations of the firm's global advisory business. Andrew's really passionate about financial literacy and has been really looking forward to reconnecting in person for the first time in over a year. So I hope that is living up to expectations. What you may not know about Andrew, he's also an avid runner, an avid distance runner, and he is a sub-3-hour marathon runner, so very impressive. So one of these people, when he's traveling around Africa, loves actually going out and spending time running. So I'm expecting him to jog up onto the stage with loads of energy and deliver his presentation on securing right price capital in 2022. Welcome. Thank you.
Thank you, Sarah. Thank you very much for the kind introduction. I'm actually not going to use the lectern. I hope that's okay with everyone. The pandemic has put me a little bit out of shape with the running. But pleased to be here this morning. Again, Andrew Brown, president of Delphos. Good, Sarah can see me now. And before I get into the slides, I thought, well, first of all, I would just say how pleased I am to be at this conference, and well done to everyone who came, conference organizers, at what I think, so the sponsors, of course, to what I think is the first in-person Africa conference since the pandemic. So, but look, before we get going into talking about securing capital, I wanted to share just a story that I'm sure many of us can relate to, and it really sets the scene for the reality, and it's a nice segue from the last discussion about institutional investing. So, a few years ago, we were working on a mandate with a very capable asset manager, sort of a $600 million managed facility they were looking to raise, and it was a very legitimate $600 million, right? They'd done it before, several billion under management, and we worked on a sort of a target list, and we identified in particular an institutional investor, a pension in the US, who has tremendous risk appetite for emerging markets, has invested in similar structures in Asia, the Americas. Had a great discussion with them. We were quite intimate, very close with them. They're impressed by our client's track record, obviously African client we're talking about here. Impressed with the track record, impressed with the management team, impressed with the pipeline, believes in the strategy. After a few months of discussions, they called and they said, we can't get there. The size is just, we need to be able to do $100 million minimum co-investments. And look, there's not a lot of $100 million co-investments on the continent. So while these guys would be the guys we would support, there's just not enough scale. And that is sort of the pretext and the premise of what we're going to talk about in terms of looking at capital market trends and talking about our approach and our philosophy to securing capital. So just before I get into that, let me just tell you a bit on, in addition to Sarah's delightful introduction, I'll just give you 30 seconds on our firm. Global financial advisory firm, 35 years of history. I'm based in DC. Hopefully you've been able to meet a lot of my London colleagues who have been out at our booth. If not, please come by and say hello later. But as a firm, we've raised about $20 billion, 80 frontier markets. That's on our capital raising side of the business. We also have a pure play sort of consulting business focused on energy and infrastructure, financial services, and structured finance with a particular focus on local currency. That's a bit of the scope. So look, these are up on the AFSIC site, of course, if you want to peruse them later. I'm not going to bore you with a number of slides. So let's talk about the promise of Africa. I'm sure many of us, most of us, have been focused on the continent for some time, right? Myself, 15, 16 years. Let's take a trip back to 2011. There's always, as there should be, optimism for Africa. But let's think about 2011. I'm sure a lot of us remember the 350,000 middle class. I'm sure we remember the Economist article. 7 of the 10 fastest growing economies will be in sub-Saharan Africa. It was in the next 5 years. But so we went back and we looked a bit, and we looked at the last 10 years, 2011 to 2020. How do the results stack up? Well, I think it's a bit mixed. Is there still tremendous growth? Was there tremendous growth in Africa? Yes. But it's not the only destination. 6 of the 10 fastest growing economies in the last decade were in Asia. Ethiopia was 1, by the way. But Africa still stacked up very impressively, 16 out of 30. But what's the issue? What's the issue for these institutional investors? It's not growth. Growth is sort of the wrong metric to look at. It's scale and size. So we did a little bit of analysis, and we said, okay, these 16 top growth economies in Africa, and they include a lot of the usual jurisdictions that a lot of us think about it, the Senegal, Kenya, Cote d'Ivoire, Ghana, DRC even. Now this analysis I'm going to tell you about, it's $586 billion of total GDP at the end of the decade for those 16 economies. But let's have a little frame of reference. Emerging markets, $586 billion over 16 economies. Turkey, single market, single regulatory regime, single domicile, $700 billion. I'll give you a non-OECD example. I went to university in the state of Ohio. Its GDP at the end of the decade was $650 billion. Now, I didn't pick Turkey and Ohio because they're good comparators to Cote d'Ivoire, but I picked them because they were relative reference points. But I think it gives some context and some perspective on the scale, which frankly creates an issue just in terms of bringing capital into the market. So if we dissect this a bit, which we're going to do here now, and we'll look at a few different segments of capital flows. Now look, I only have 15 minutes, so I can't talk about all of them. So we're not going to talk about China, ODA, public markets. The last discussion was great on talking about some of the public markets and institutional investors. But we're going to talk a bit about trends that we're seeing at Delphos around DFIs. We're going to talk a bit about foreign direct investment, and then we'll talk a bit about what we're seeing in the public equity space. There we go. So fact 1, the African continent is an ever-important destination for DFIs, right? I mean, I think everyone here probably already knows that. So, but you see a couple of visuals, and we want to unpack these numbers a bit, right? On the left, you see the growth numbers. Now there's some variance from, we picked a few DFIs, from DFI to DFI in terms of how they grow. But generally, they're all, which is great, putting additional dollars, additional commitment dollars into the continent. And for the African economies, it's supercritical capital, as you see, as it relates to the size of their GDP. But what's important in terms of the nuance, in terms of the mixed messaging? Now, this isn't an editorial, but the reality is much of that capital goes to, it's sort of a flight to winners, and goes to what I call sort of politically safe type of transactions. Large banks and financial institutions, politically safe infrastructure projects, re-upping to some of the same managers. I'll give you an example. There's a European DFI. I'm not going to say, but you can go do your own work. There's a European DFI who, a great champion of the continent. We looked, and in the last decade, they only enter into one new manager relationship per year in Africa. So what does that mean? That means it's a lot, and that's not first-time fund managers. I'm talking about new relationships, right? So it's a lot of re-upping to the same managers. And again, the comment is not so much of what should or what shouldn't be. The comment is actually, while there's a lot of DFI capital, a lot of that DFI capital is going to the same recipients. And so what does that mean? That means if you're not necessarily yet in that, if you're in that ecosystem, then the question is, how do you optimize what you already have? If you're not in that ecosystem, then the question is, what is the strategy to get into the ecosystem, or what's an alternative strategy to be able to attract capital? Okay, so fact 2, direct investing. I mean, look, the top line here is bad, right? I mean, you can see the decline from the prior decade to the second decade. Or, sorry, you can see the decline from sort of the 08-10 period to 18-20 period. So even leaving COVID aside, there are some declines. I think maybe the more concerning, I think that's going to reverse. And so I'm not too concerned about the overall decline. By the way, these are constant dollars. So I mean, these aren't inflation adjusted. So the actual trend on a real basis is, they are adjusted because this is real. So the actual performance, if they were inflation adjusted, would be even worse in terms of a decline. But the more concerning thing, I think, is actually the concentration of the foreign direct investment. And it's a similar theme as we see in the DFI space, and that it's a lot of a flight, I wouldn't say so much flight to winners, but capital is concentrated, right? Where is capital concentrated? I mean, anyone who knows Africa well can look at this heat map. You pick up a lot of these markets. What do they have? Congo, Gabon, Nigeria, Mozambique, Egypt, right? Natural resources. Africa is the only emerging market region where the majority of FDI deployment is around employment in low skill and natural resources. In other words, if you look at Asia by comparison, the majority of FDI there is around high-skilled labor jobs. Now, there is a lot of positivity and silver linings around this. That high-skill number within the Africa context is rapidly increasing year on year. I'd say the big takeaway, though, from sort of what we see on the foreign direct investment side is it's a lot of $2 billion, ExxonMobil, $1 billion, $1.5 billion. And so it requires an adjustment and a calibration of how am I going to approach the capital markets and how am I going to secure capital for my fund, bank, financial institution project. Now let's talk about a favorite topic, private equity. I know they've got the super returns in a few weeks here, but which isn't a plug for that. We're not a sponsor. But we can sort of debate whether the trend line is flat, whether it's slightly going up. But I think we can all agree that LP capital is scarce. Back to my friend, the North American Pension Fund. I'd say the one thing that maybe provides some comfort here is everywhere emerging market private equity outside of China has been getting beaten up in the last 10 years, right? That 2.25% actually outperforms Latin America, which is even worse. We're sort of global advisory, so we cover that region as well. But there's a sort of a few trends to think about. One, the returns are bad. So whether we're comparing it to Latin America or not, this is why there's a decrease in appetite, or why there's not an increase in appetite. Let's turn that around. Two, that 2.25 I actually think is higher than the number in reality because there's survivorship bias, right? If you're a fund manager who has a negative 70% return, these are all self-reported, right? You're not going to report that number. So the number may be closer to 0 or negative potentially. We see the decline in first-time fund managers decreasing. And again, this is less of, back to the point about the DFIs, it's less of an editorial on what's right, what's wrong, how should development happen, but the point is capital is scarce. So if you sort of summarize these, got flight to winners, FDIs in decline, and there's scarcity of LP contributions. Now this isn't intended to, I asked my colleagues, I said, does it sound too doom and gloom? So Look, I think there's a lot of reasons which have been discussed here today of why there should continue to be enthusiasm. Look, the growth is still there. In the long term, the macro story is there, right? 41% of the world's working population in 2100, in 80 years, will be in Africa. So there's definitely a need and an interest from certain parties for investment on the continent. Really what this means is if you're going out to secure capital for your transaction, one needs to have a clear and sober mind about how you're going to do that. So I'll sort of talk about 4 things that we think are important that all sort of tie together. Number 1, maybe most important, investor motivation, right? Investor creditor motivation. What is it that's motivating your counterpart or who you're going to in the capital markets? Is it yield? Is it political, geopolitical? I think DFIs, right? Is it they're reaching their year end and they need to push out allocation? Is it that understanding that question will help drive the next thing, which is precision in the capital markets. And precision means calibrating. This is sort of the second point is precision. Calibrating 2 things. 1, or I guess third, calibrating a compelling story. And so the story it ties back to the investor motivation. So once you understand the investor motivation, and then you can precisely calibrate compelling storytelling, obviously assuming the commercials are there, to think about how you're positioning your investment offering, your credit offering, your manager, your fund manager, your corporate into the ecosystem. So investor motivation, precision, storytelling, compelling storytelling, and then fourthly, timing. All of this only ties together if you're understanding the cycles, the investment cycle. I talked about, is the motivation pushing out money before the year end? So one question would be understanding when they're making investment decisions. So how do we do that at Delphos? Of course, I couldn't leave without giving a quick plug for a minute or 2 on us. Look, I'm not going to bore you with all of our slides, so I will just talk about, though, our approach, which are sort of our 4 Ps in terms of how we do our service offering and how we calibrate an approach to the market. And the first one is people, right? We have close-knit relationships with the capital markets. That's because we've been doing this for decades. And so the associates, investment officers, managing directors, CIOs we work with are also, frankly, our friends. We've worked with them for years, and we see them at these events. Our second P is, and these all tie together into the capital raise process. The second are programs. Because of that proximity, and I think people are, frankly, even more important than institutions, right? At the end of the day, this is a people business. That's why we all wanted to come to this conference, so we could shake hands, mingle, and if you went to the reception last night, yell in each other's ears to trade market intelligence. So with that intimacy with people comes an understanding of programs. We take pride in structuring bespoke, what we like to call off-menu item capital solutions. So everybody didn't know there's a $50 million pool of money for climate support in a particular DFI that they're using for supporting development of projects. Thirdly, pricing. We've worked on thousands of transactions. With that comes, that helps in 2 ways. 1, it helps in terms of our clients getting optimal terms. But 2, for the benefit of capital sources, we know the bounds. We're not going to waste 2-3 weeks going through a process when we know there's no way that capital source is going to negotiate that term away. And then lastly, practicality. Roll our sleeves up. Find a solution that's workable, viable, and sometimes the solution may be there's not a solution right now, and that creates efficiency in the market. So I think that pretty much covers the theme, some representative transactions, but with 2 or 3 minutes left, happy to take any questions.
Good morning, Nicolas Clavel from Pion Capital. Once you have identified a great idea, that everything is a great idea, and you have made your presentation pack and you start speaking to DFI, how long would you expect them to come back with a decision?
I will give you an answer, but I would love to sample this room and see what they think. I mean, look, I'll give you some facts. The fastest we've ever done a process is 4 months. We've had some process last years because it's a highly complex, tough jurisdiction, infrastructure transaction. Usually they're about a 9 to 18 month sort of process, depending on the structure and the capital. But, Anything else? Super. Well, thank you so much. We brought us back on time.